the downsides of the union budget announced this year was the proposed tax on all angel investments in the country. Many are calling it the startup tax. Here's a special report then on the implications of this proposed tax, what it is that angel investors in India are planning to do about it, and whether or not, as an entrepreneur, can you possibly avoid it.
It's a sinking feeling.
It's a retrograde step.
It's as if you're thrown in water, you're trying to not drown, but it's a helpless feeling.
Yes, the announcement of the budget last month sent shock waves within the investment community. Ever since, angel groups like the Mumbai Angels here behind me and the Indian Angel Network have been working hard lobbying with the government to reduce the impact of what many are referring to as the startup tax. But what are its implications, and is there any way startups can reduce this proposed burden on them? We bring you a special report. First things first, the new clause is a part of section 56(2), which states that the new clause will apply where a company, not being a company in which the public are substantially interested, receives in any previous year from any person being a resident any consideration for issue of shares. In such a case, if the consideration received for issue of shares exceeds the face value of such shares, the aggregate consideration received for such shares as exceeds the fair market value of the shares shall be chargeable to income tax under the head income from other sources. Breaking this down, assuming that an angel investor invests 1 crore for a 25% stake in the company, the startup is valued at 4 crore rupees. However, assuming the hypothetical fair price valuation of the company as assessed by an assessing officer is pegged at 1 crore rupees, the taxable premium is equal to the value of the investment subtracted by the investor's percentage of stake in the fair price valuation. In this case, the tax deducted amounts to 22.5 lakhs rupees, which will be borne by the startup. This tax legislature is scheduled to go into action next financial year, and its impact is so severe that if passed, angel groups believe it can threaten the very future of angel investing in the country.
There will be somebody else which is not an investor and not an entrepreneur who would be valuing the company, and anything invested beyond that valuation will be considered as income or premium which will be taxed. So in essence, what does happen? Entrepreneurs put in sweat and money, they put in IP, the valuation comes much later in terms of a tangible valuation. Beauty lies in the eye of the beholder, be it the investor or the entrepreneur, and that is very different from some third-party valuation.
The tax has in many ways been triggered by the 2G scam and has been institutionalized as a method to prevent money laundering. But in doing so, it's also put the country's angel investment industry in peril. Ever since the bill was announced, angel groups like the Indian Angel Network and the Mumbai Angels have come together to lobby with the government on the bill. The progress so far at least has been slow, and angel groups are lobbying for certain amendments in the bill which they believe will tide in their favor.
Below a certain limit, 5 crores, those kind of investments can be exempted from this. The second thing they can do is probably recognize the angel groups and probably have KYC norms just like the US, and each individual angel investor is actually a certified investor and they are exempted, or at least for the time being the convertible debt option also be exempted.
The other key question that's being pondered upon by tax experts and lawyers alike is how the startup community can respond to this bill if it indeed does get passed. Are there possible ways to structure your firm to reduce the burden of the startup tax, and how feasible can these strategies be in the long term?
One would be like to continuously do a book building on your book. So for now example, right, when the founders quit their job and form a new startup, they have always been cribbing about their opportunity cost, the cost of leaving their job and working on the idea of the startup. So these things has typically not been capitalized in the books of company till now. Second workaround could be like you can actually take the money from the investors at fair market value, and you can take some additional money as unsecured loan for a longer duration, committing okay, we will use the money for the growth of the business, and then they become the shareholder. They can actually give you money.
There are things that some people are talking about kind of a brain drain, where you take the company and register it in Singapore, and if it's a global operation firm, you actually move the firm to Singapore. If it's an India business, it's a firm registered there, team sitting here. But what's not very clear is firm from Singapore coming and doing business in India, even though by Indians, what are the tax implications of that?
While there are a number of methods and strategies being discussed, it's still too early to comment on their feasibility. All eyes are clearly on the next session of the Parliament when the budget will be passed. Angel groups are no doubt hoping that their proposed amendments are taken into consideration before the passing of the revised Section 56(2).